So you have savings, but you don't know how to invest your money, or maybe you have money invested, you're just not happy with the returns. In this video, I'm going to talk to you about something that's called the lazy portfolio. It's really easy to set up. It doesn't cost much money, so the fees are really low. You can look at your portfolio once a year and you can relax about your investments, knowing that it generates a decent return, it's well diversified, it doesn't cost a lot of money, and it doesn't take your continuous attention. So stay tuned. Hi, my name is Julien, Regoli, CPA, CMA, finance coach. My purpose is to demystify money matters and finance and help people learn how to save money and invest money so that they can reach financial freedom more rapidly. If this topic interests you, then subscribe to my channel and hit the bell button. You'll be notified whenever I upload new videos. So the idea of the lazy portfolio is to invest money headache-free, low cost, well diversified, and earn a decent return in the process. So here it is. There are two components to the lazy portfolio. There's an equity portion, equity meaning you're investing in the stock market, and there's a bond portion, you're investing in the bond market. The equity portion is more volatile, so more risky, and the bond portion is less volatile and less risky. With the lazy portfolio, you look at your age, and your age equals a percentage that you're going to put in the bond investments. So say you're 30, then 30% of your portfolio will go in bonds and 70% will go in equity. And you review that every year. Here's my recommendation as to where you're going to invest the money. So as you know, I'm a big proponent of ETFs. Exchange traded funds. Why I like ETFs is that you have access to a pool of stocks at a low cost. I prefer ETFs over mutual funds because ETFs cost about 10 times less than mutual funds and they're more tax efficient. So if you have US dollars to invest, here are the ETFs I recommend. So there's the SPDR, S&P 500 ETF, ticker is SPY, has an expense ratio of 0.09%. Wow, that is so low. You know, a lot of mutual funds are 1, 2, 3% with front load and back loads. This is, look at that, 0.09%. So it's 10% of 1%. So that's very low. It has dividend yield of 1.59% as of today, November, where are we? November 20th. So that's not too shabby. That's the annual dividend yield, and that's paid quarterly. So over 5 years, 89%, over 10 years, 263%. It's one of the largest funds in North America for equity. It's got $320 billion of total assets under management. It's been in existence for over 20 years. So this one is the iShares Core US Aggregate Bond Fund ETF. Even less of an expense ratio at 0.04%. Generates higher yield at 2.23% annually. I think this one is paid monthly. It's got $82 billion of assets under management. So another very, very large ETF. It's been in existence for a long time. Inception date is 2003. If you have US dollars and you're looking to buy into bonds, AGG is what I recommend. And if you're looking to buy equity, SPY is what I recommend. If you have Canadian dollars and you want to buy equity, I recommend XIU.TO, iShares S&P TSX 60 ETF, and it follows the 60 largest by market capitalization and most liquid securities listed on the TSX. Expense ratio of 0.15%. Dividend as of today, over 3% annually, almost $10 billion of assets under management. It's been in existence for over 20 years. It's got a good track record. If you have Canadian money and you're looking to buy into bonds, this is the one I recommend. It's the iShares Core Canadian Universe Bond ETF, XBB.TO. Expense ratio 0.09%, over 2.5% dividend yield. Look at this graph. This is just an amazing graph. So over 20 years has generated 175%. Just beautiful. See, the volatility on this is very low. So this is the XIU investment compared to the XBB. So you can see that the equity investment over 10 years is more volatile, clearly, as you can see, and has generated more return compared to the bond that is less volatile but less of a return. Now, if we look at our US investments, we have the SPY that follows the S&P 500. We have that 263% over 10 years compared to the bond fund, iShares Core US Aggregate Bond, 43%. And again, I mean, you can see that the bond ETF is way less volatile. Return is less also. The equity ETF here has a higher return but is way more volatile. And to further diversify your portfolio, what I recommend is you hold 25% of another currency. Say you're in Canada and you have Canadian dollars. I would invest 25% of your portfolio in another currency. The closest one is the US dollars. It's easy to set up a US account. It's easy to buy in Canada. The logical choice is if you're in Canadian funds and want to diversify 25% in another currency, the US dollar is a really good one. If you have US dollars, you could buy 25% Canadian dollars or euros. So I recommend that you further your diversification of your portfolio by taking 25% of your portfolio and putting it into a different currency. Every year, you're going to adjust your lazy portfolio to make sure that it reflects your objective. My lazy portfolio recommendation is a guideline. You may be less comfortable with volatility. You may not like risk as much as most people. If that's your case, maybe you want to bump up the bond portion. That all depends on your volatility tolerance, your risk tolerance, and everybody is different there. So adjust accordingly. I'm just giving you a guideline. Reinvest the dividends that come out of these investments. They will pay you in cash, some of them monthly, some of them quarterly. Make sure that you don't leave cash around. Make sure you invest that money. So there you have it, the lazy portfolio. If you have any questions, leave me a note. If you want to book a one-on-one with me, we're looking at different investments, you have some questions, you want to strategize on your financial situation, book a one-on-one with me. You can do that. There's a link in the video description. Make sure to like my video if you like it, and stay tuned because more videos are coming up. Thanks for watching today, and we'll see you real soon.